Hello, and welcome to Optimum Solutions Educational Webinars. My name is Susan Warren, and I'm a member of Optimum Solutions support team. I'll be your host for the educational webinars. For our educational webinars, we've selected topics that we think will be of interest to payroll and HR professionals, and we hope you learn lots of useful tips from watching our educational webinars. If you think of other subjects that you'd like to see presented, please email me at swarren@optimumhris.com. Thanks for watching and enjoy the webinar.
Welcome to Optimum Solutions Tax Cuts and Jobs Act webinar. My name is Susan Warren, and I'll be your presenter today. Tax reform has been in the news all year, and today we're going to take a quick look at how it affects those of us in payroll, as well as our customers, our employees. When we're done today, I want you to have a better understanding of what the Tax Cuts and Jobs Act has changed and how those changes will come about. Today, we're going to look at TICJA, that's what the folks in the government affectionately call it, and how it's been designed to work. We'll look at income tax rates and brackets and federal income tax withholding, something you work with almost every day, but rarely see because it's behind the optimum scenes. Also, we're going to discuss changes that are happening to personal exemptions and standard deductions. Something we're going to spend significant time on is Form W-4 and the new IRS withholding calculator. A few things we'll look at that you may already be aware of are changes to the way that federal tax levy exempt amounts are calculated and some fringe benefit taxation changes. Did you know that there is a new employer tax credit that you may be able to take if you pay family medical leave to employees? We'll cover the details on that. And then we'll look at a few other miscellaneous odds and ends. I know it was an anxious time for those of us in the payroll software industry, and it was likely an anxious time for you as well. But go back with me to December of 2017, when President Trump signed the Tax Cuts and Jobs Act for tax years 2018 through 2025. And the IRS said on December the 17th that there would be new federal tax tables for 2018. Oh, really? In 2 weeks, you're going to publish, and we are going to implement new federal tax tables? And after a mild panic, what really happened was that they actually got the tables out pretty quickly, January the 11th. And they gave us until February the 15th to actually start using them. So it really wasn't that bad after all. We just continued to use the 2017 tables until we had the new tables in place. Now, what the new tables did for you and me and almost everyone we pay was that it lowered federal income taxes, thereby increasing take-home pay and stimulating the economy. But there's another bit to the tax cuts part of the act. There are also tax cuts to corporate taxes, which is not part of what we're going to look at today. But theoretically, corporations will have more money to pay existing employees and to also hire new employees, hence the jobs part of the act. And that part seems to be working so far, as the May jobs report last week showed that the economy added roughly 223,000 jobs last month, and the unemployment rate is at an 18-year low. Also, you may remember that quite a few large companies were in the news early in 2018 announcing that they were paying substantial bonuses to all of their employees because of all the tax savings that they would realize from the reform. And your company may have even done likewise. So far, the Tax Cuts and Jobs Act seems to be a success. As far as getting those college graduates jobs, we're working on that. While there are still 7 tax brackets, both the tax rates and the ranges of those 7 tax brackets have changed. Now, because Optimum Solutions furnishes the tax tables for you, you may not have even seen the new tables, and this is not what the tables look like in your software, but here are some examples. This is a table comparing the 2017 and the 2018 single and married brackets and rates. So I want to take just a minute to look at these. On the top here, we have the single tables for 2017 and 2018. We have the rates and then the brackets. So let's look at the rates first, and you can see that the rate, the lowest rate for both years was 10%. And then we see changes. It was 15, but now it's 12, 25, and now 22, was 28, and now it's 24, was 33, now 32, was 35, still 35, was 39.6 for the highest rate, and now the highest rate is 37%. Those rates are the same for married. Changed to be the same for married. Now let's look at the brackets. The bracket for the 10% rate didn't change very much. You can see it went up just about $200. For the 12% rate, again, that bracket didn't change dramatically. Still 9,500 to 38,000. That didn't change, the range of that bracket didn't change that much. But the next bracket, there's more of a significant change. That top end is significantly lower by about $10,000. The next bracket, you can see a quite significant change. The top end of that bracket was 191,000. Now the top end of that bracket is only 157,500. The next bracket, again, a significant change here. It was 191 to 416,000. That bracket is now 157,000 to 200,000. So that's only a $50,000 range in that bracket. The 35% bracket is where we see the largest change for both single and married. So this is where the largest change is happening. This is now a $300,000 bracket. So lots of taxpayers are falling into this bracket that never fell here before. You can see this bracket was a very small bracket before for single and married. Now it is a very large bracket for both single and married. This is probably where we're seeing the biggest difference, in the 35% bracket. As we've already discussed, these tables were released January the 11th, and payroll departments were given until February the 15th to begin using them. The majority of employees realized a lower federal tax liability and increased take-home pay. Something else that the Tax Reform Act did was it lowered the supplemental federal tax rate from 25% to 22%. So if you have that rate set in your code tables somewhere, you should change that if you haven't already done so. Also, the Tax Reform Act lowered the mandatory withholding rate on supplemental wages over $1 million. That rate is tied to the highest income tax rate. And if you'll remember from that table we just looked at, that highest income tax rate went from 39.6% down to 37% for tax years 2018 to 2025. And there is a new two-step calculation that should be used to calculate the amount of income tax to be withheld for non-resident alien employees. There are tables that you will need for this calculation, and those tables can be found at irs.gov/notice 1036. And of course, I will be sending all of you this PowerPoint, so you will get this link. Don't bother to write this down. Most of you probably do 1099s, or your accounts payable folks do. So when you have a 1099 with no taxpayer ID number, backup withholding is linked to the fourth lowest income tax rate. And on the new tables, that decreased from 28% to 24% for tax years 2018 through 2025. Two very significant changes that the Tax Cuts and Jobs Act made are that it did away with personal exemptions and that the standard deduction has substantially increased, as you can see on this table. Before the Tax Cuts and Jobs Act, married filing jointly, standard deduction was $13,000, but after the Tax Cuts and Jobs Act, that increased to $24,000. You can see that married filing separately, single and head of household, Tax Cuts and Jobs Act increased those standard deductions almost by double. For taxpayers with qualifying children, the child tax credit doubled from $1,000 to $2,000, with a maximum refundable amount of $1,400 per child. And for the duration of the reform legislation, there is also a $500 non-refundable credit for qualifying dependents other than qualifying children. And of course, there are wage limits on those who can qualify for this credit. Now, because of all of these changes, the IRS did issue a new Form W-4 for 2018, but the form itself is not new at all. However, the instructions for that form and the worksheets have changed a lot. But what's even better is the IRS new withholding calculator at www.irs.gov/W4app. Now, this would be a great paycheck stuffer to put a note in with your checks that employees could go there to look at this withholding calculator, or even a training session to share with your employees that they should go to the withholding calculator and check that out. For those employees who want to check the exempt box, and we all have some, well, they can still do that, but they still have to fill out a new W-4 by February the 15th every year. That did not change. If the employee wants to use the Form W-4 worksheets to determine how to fill out the form, there are 3 worksheets that they can fill out. There's a personal allowances worksheet, a deductions, adjustments, and additional income worksheet, and a 2 earners or multiple jobs worksheet. But if they want to use the online calculator, that is actually considered more accurate, so they don't need to bother with those worksheets. But don't be surprised if nearly everyone who uses the online calculator submits a revised W-4 to you, because tax withholding is going to change, especially for taxpayers who have 2 income families, or people who work 2 or more jobs at the same time, or maybe only work part of the year. Or remember that the tax credit has doubled, so those who are filing that tax will probably have a revised W-4. Or anybody who itemized deductions last year may need to file a revised W-4. Or people with very high incomes or complex tax returns. You may also want to have on hand publication 505, which is tax withholding and estimated tax, in case anybody asks you questions about complicated tax situations. And of course, remember that you're not allowed to advise anyone on how to complete a Form W-4. However, giving examples with actual calculations is not advice. That's merely information. If you explain to someone what a calculation will be, if they choose to elect married and 3 exemptions, that's not advice, that's just information. Although Form W-4 itself did not change for 2018, we do expect a complete overhaul for 2019, and that should be released later this summer. Now, while there will not be a mandate that all employees file a new 2019 Form W-4, the IRS will most likely strongly encourage everyone to do so. So you can expect to see a lot of information coming your way about a new Form W-4. And while it's not really part of the Tax Cuts and Jobs Act, another encouraging announcement was the IRS's 5-year strategic plan. Like the online calculator for withholding, this 5-year plan is aimed at making taxes and all things IRS related easier for the taxpayer. I recently heard the acting commissioner of the IRS speak, and he was both upbeat and surprisingly entertaining. The IRS seems to be really working on improving its image and building a brand for itself. They're very concerned with the integrity of the data that they bring in and push out. And they're very interested in keeping up with technology and being a friend to the taxpayer. They're interested in repairing what they perceive as a bad reputation. So I think they're on the mend. As we mentioned earlier, Tax Cuts and Jobs Act eliminated the personal exemption, but you will remember, of course, that the personal exemption played a major role in how you used to calculate the weekly exemption from a federal tax levy. So on December the 31st, the IRS published new tables for figuring the amount exempt from the levy on wages. Now, they began their formula by using what would have been the personal exemption for 2018, which would have been $4,150. Multiply that by the number of the taxpayer's dependents for the tax year, plus the standard deduction, and divide that sum by 52. So here's an example, $204.81 per week. You're probably already doing these calculations. And for those employees who do not return to you their Part 3 of Form 668W, Tax Cuts and Jobs Act changed how you handle that calculation. It used to be you would treat them as if they were married filing separately with one dependent, but now you should calculate as if they are married filing separately with no dependents. Just last month, we did a webinar on taxable and non-taxable income and spent a lot of time looking at the taxation of fringe benefits. Moving expenses is one that we did not go into a lot of detail on, mainly because it is very complicated and there is a lot of detail. But The Tax Cuts and Jobs Act makes employer payments and reimbursements for moving expenses taxable for federal income tax, FICA, and FUTA, with the exception of military personnel following an order for a permanent change of station. And that's basically military personnel exiting the military. Those reimbursements for moving expenses are not taxable for federal income tax. Now, some states follow Internal Revenue Code prior to January 1, 2018, and some states follow Internal Revenue Code after January 1, 2018. So you need to know what your state does in order to know if these moving expense reimbursements are taxable for your state income tax or not. There is no more qualified bicycle commuting reimbursement exclusion for the duration of the Tax Cuts and Jobs Act. Also, the personal use of a company car benefit fair market value can only be calculated with the cents per mile method if the vehicle is not a luxury vehicle. And the new definition of luxury vehicle is supposed to be forthcoming. It's not a change that you must give tangible property for employee achievement awards, but it is a change that there is now a definition of tangible property. Well, it's not so much a definition as telling you what it's not. Tangible property is not cash, cash equivalents, gift cards, gift coupons, gift certificates, vacations, meals, lodging, tickets to sporting events, theaters, stock. In other words, tangible property is not anything that can easily be accounted for as cash because cash is taxable. There will be a couple of new W-2 codes for Box 12 this year, GG and HH. And that's to help report some new options available to employees who exercise stock options. The Tax Cuts and Jobs Act allows qualified employees to elect to defer, for federal income tax purposes, the income from some stock options so that they may have time to accumulate funds to pay the withholding taxes on the income they gain from those stock options. There is a new employer tax credit for qualified employers who pay family medical leave to qualified full-time and part-time employees. For an employer to qualify, they must have a written policy published that outlines at least 2 weeks of annual paid family medical leave for full-time employees and a proportional amount of paid family medical leave for part-time employees. For an employee to qualify, they must have been employed by the employer for at least a year, and in the preceding year, they may not have received compensation in excess of 60% of the amount used to classify as highly compensated. And in 2018, highly compensated is $120,000. So 60% of $120,000 is $72,000. Now, note that if your policy requires that vacation or PTO time be used before family medical leave pay kicks in, that paid vacation or paid PTO time is, of course, not included in the wages subject to the tax credit that you might qualify for. Common sense. Qualified employers can take a general business tax credit of 12.5% of the wages paid to the employees on family medical leave if the employees are paid at least 50% of their normal wages and that credit increases by 0.25% for each percentage point that wage payments exceed 50%, up to a maximum tax credit of 25% of wages paid. The credit can be applied to family medical leave wages paid for up to 12 weeks. Remember that some of the things that we've discussed today, although we have discussed them from the federal perspective, may affect your state tax tables or taxable wages. If your state uses the federal tax tables as a basis for your state taxable income or state personal exemptions or state standard deductions, be aware that those things might change because the federal has changed. The Tax Cuts and Jobs Act also repealed certain itemized deductions on personal tax returns. And you probably saw this last year. Mortgage interest on mortgages in excess of $750,000, some taxes in excess of $10,000, charitable contributions for certain things, deductions for certain job-related expenses, and miscellaneous deductions subject to the 2% adjusted gross income floor. And then there are some unreimbursed employee business expense deductions that remain unchanged by the Tax Cuts and Jobs Act, like dues, job search expenses, tools, travel, transportation, meals, lodging, and entertainment, union dues, work clothes and uniforms, work-related education, employee use of company vehicles, and employer-site provided cell phones. Those still remain non-taxable. Because the Tax Cuts and Jobs Act took away the option to deduct miscellaneous amounts on individual tax returns, repayment of income from a prior year up to $3,000 may no longer be claimed as an itemized deduction. So if you have employees with this question, refer them to publication 525, which is taxable and non-taxable income, if you have any questions about repayments of wages that you made to them. I want to thank you for joining us today. We hope you've learned more about the Tax Cuts and Jobs Act and how it affects those of us in payroll, and also how you can better educate your employees on their paycheck and the differences and what they might expect when they get ready to file their personal returns. Please be on the lookout for more of our educational webinars soon, and please email me if you have any suggestions for topics you'd like to see in future webinars. And we hope you have an optimum day.